Hello there. Welcome to lesson number 3 of the Equity Masterclass by Already Late, your favorite channel for anything related to money matters. In the previous lesson, we saw the two ways of making profits in equities. In this lesson, we will understand the three roles that you are likely to play while participating in equity markets and how any overlap of these roles will lead to a rapid destruction of wealth. As you already know by now, equity markets are so dynamic in nature. There is no restriction on the time frame of investing, and there is rapid movement of prices on both directions. This nature of equity markets brings out various personalities of yours outside. There is an investor in you who wants to buy good shares and stay invested for a long term. There is also a trader in you who wants to take calculated risks and earn extra profits. And finally, there is also a gambler in you who wants to follow the instincts and go all in for a big kill. It is these three personalities which you need to manage. You need to keep them isolated and ensure that there is a right balance between these three. I will tell you how to do this in a very simple manner. The first personality within you is that of an investor. This is the ideal version of your own self. As an investor, you have an extremely high probability of making steady and decent returns. To ensure the investor in you works perfectly, you need to always invest with an investment objective. Link your investments to your future goal. Maybe you're investing for a happy retirement or buying your dream home, or it could be anything else. Linking your investments to goal will discourage you from doing anything silly and against that plan. Because whenever you get tempted, you will always visualize the larger things, the plan. What happens if it just gets fulfilled? And any mismatch there, you would not want that visual effect right in front of you. You would not want to hinder that. You would not want to hamper the progress towards your goal. At regular intervals, maybe once a quarter or even a higher time period, just check your investments and make any changes only if it is necessary to do so. Otherwise, don't do anything. We will discuss all these necessary situations when you actually have to do the changes. We will discuss these in further lessons. Never ever fiddle with this part of your equity investments. Just do not get tempted at all. The second personality is that of a trader. This is that part of you which feels that you have enough knowledge using which you can make money through equities in a very short duration, usually a few days to a few weeks. Now, this requires a lot of knowledge and an even great level of control over your transactions. When you are a trader, your sole objective is to earn that extra money quickly. If you are on the right side of the trade, you indeed make some extra money. There are a couple of factors which causes downfall of a trader. First, in the quest of high profits, many traders end up with high number of transactions. Now, while profit is not a guaranteed outcome of these transactions, the associated costs in the form of brokerage and taxes are always there and just increasing with every transaction. Before you realize, your costs have eaten away a significant part of your gains if you actually made any. The second factor that causes the downfall of a trader is the trader himself. You end up making mistakes. Mistakes like not accepting when you are wrong about a particular trade. Now, this might result in more and more losses. Mistakes could be increasing stakes either because of overconfidence or because you want to correct a previous wrong trade. You just increase your commitment. And these mistakes will result in heavy trading losses in a real quick time. And that is why I said earlier, as a trader, you need a great level of control over your transactions. The third and final personality is that of a gambler. As a gambler, you are expected to lose. Well, surprised? Now remember the saying, the house always wins. Now, most of us know this fact that when we are gambling, the end result is we always end up with a loss. But we still gamble. Why? Now, whether it's at casinos or on our cell phones with the latest fantasy leagues, we always gamble. Why do we do this? Because there are moments in our lives when we forget the basic fact that we just cannot win against the house. It is during these moments we have an adrenaline rush and we think that we are invincible. As a gambler, we just have to follow a gut, and we might be even lucky and start with a win or two. One simple example of a gut feeling is when I come across many people who buy a particular stock only because it has fallen for a couple of days. The logic is very simple. This stock fell yesterday and today, so it should go up tomorrow. Now, is it even logical? Having understood these three types of personalities within us, it is important to know how to manage these personalities. The simplest approach is by not being a trader and a gambler. But as I told you, it's just not possible to suppress any of these three within us. These are all part of us, and we just can't do anything about it. We have to live with those. The only way to ensure that you do not destruct wealth is by ensuring you do not mix these personalities. Let me share a personal example from a period when I was very raw in the equity markets. This was back in 2008, and I was working with a stockbroking firm. I was on the trading system and I saw that Development Credit Bank, which today is known as DCB, had fallen by over 5%. Now, my gut told me that I should buy because there is a high chance that the stock may open up the next morning. I bought 100 shares at around 112 rupees. The idea was to sell the next day at around 118 or 20 and earn some real quick money. The next day, the stock price was at 106. So what do? I bought another 100 shares and thought that now that the share price has gone down for two consecutive days, tomorrow would be my day. It will definitely go up and I will sell my 200 shares at 112 or 115 and make some decent money. Now, the next day, the stock was at 100 and I was still not ready to accept that I had made a mistake. I bought 200 shares more at 100 rupees and now I had 400 shares at an average of 105 rupees. The prices had fallen for 3 days in a row. There is no way on earth the price could go down for the fourth day, right? That was what my thought process was. 95, 90, 87. These were the prices of the shares in the next 3 days. Now I neither had the courage nor the money to buy more shares. And I did not have the appetite to lose 20 rupees on every share for the 400 shares that I had purchased. The only alternative left was to wait. I'm sure you would also do the same. Probably wait for a few days or a few weeks and sell the shares when the prices actually went up again. And that is exactly what I did. Waited and waited and waited. And in the span of next 9 months, the stock was at below 20 rupees. Now, do you want to know what I did later? If yes, leave a comment and I will definitely update you on what I did later. So if I were to ask you, where did I go wrong? Was me purchasing DCB without any study wrong? You might say that yes. Maybe yes, I was wrong, but I would forgive myself for that mistake of mine. Why? Because I was just following my gut instinct. I was just taking a bet. I was probably gambling. My mistake was to convert something that was a gamble into an investment. My mistake was that I could not accept loss out of a gambling transaction. My mistake was that I mixed two of my distinct personalities. Have I stopped trading or following my gut? No. Have I found a solution? Yes. The solution is very easy, though I learned it a very hard way. Whenever I get an urge to trade or gamble, I set aside a certain sum of money that I can comfortably lose, and I only transact using that money. If that money is lost, no matter how strong the gut is, I resist it just by thinking of my recent losses. This way, my investments do not get affected. There used to be a point in my investment journey where most of the shares in my portfolio were there only because they were not profitable. I have learned this the hard way, and now I ensure that I do not convert my trades, my speculative trades, into my long term investments, irrespective of the losses that I may incur while exiting those transactions. So, all you need to do is just two things: set aside an amount for trading and do not convert your trade into your investment. If you're not able to do this, any amount of knowledge, trust me, it will not help you generate wealth because you will always end up losing big time and again. I hope after watching this, you will always remember that you should not mix your personalities and you will not go down the road that I had gone. In the next lesson, we will get into understanding equities by getting to know the different types of stocks that are available for investing and how these can be used to construct a great portfolio. Until then, do not forget to like and share this video and keep learning and spreading knowledge. Thank you.